Hello and welcome back to the ROI Channel, the channel that's obsessed with the art and science of return on investment. And today, stock analysis, a very brief overview on an onshore oil service company. It's very interesting. I do not currently have a position in it, but it's certainly on my watch list. We're going to talk about ProPetro. Disclaimer, of course, nothing I say here is to be considered advice. It's just my opinion, thoughts of one crazy man. So please, for the love of all things holy, don't listen to what I say. Make sure that you seek your own personalized, qualified investment advice. And I am not a financial advisor, so I can't do any of that for you. Today is purely for entertainment purposes and me sharing my opinions. Executive summary of the business. So ProPetro oilfield services, as I mentioned, it has started to, I guess, in a way, diversify within the related field. They've been acquiring some cement and service companies. It provides the pressure pumping and related services regarded or required for fracking. Okay. Serves the upstream segment of the oil and gas value chain, and they're, as far as I'm aware, exclusively focused in North America, particularly in the Permian Basin, where, of course, you have your main fracking and shale wells. So what's going on here? The thesis, oil demand is unrelenting in the face of dwindling supply growth, and I think that we might get up a little bit closer to the $90 WTI mark towards the end of this year. In any case, eventually the Permian production is becoming more and more gassy from everything that certainly that I read. And my read on that is the world is still reliant on the shale patch. They're expecting the shale patch to grow. If on the one hand that expectation is present, yet the wells cannot really deliver the liquids content to the degree that people expected, more and more capex will initially be needed just to keep the same amount of production. So that's my idea. It's my thesis for these types of companies. That capex, of course, would be the revenues, growing revenues for oil service cos such as pump. If we look over the last year and over the last 5 years, this company has gone up, it's gone down. It's currently sitting towards the middle to lower end of its price range, yet its book value has been able to maintain a steady increase more so over the last year to 2 years. So what that is reflective of, this company has cleaned up its balance sheet. It's made some pretty decent acquisitions that will provide double-digit return on equity. And so it is interesting in that scenario. It's sitting around about its book value, and it's just crossed through the 200-day moving average, as you can see there being the light blue line, and then the book value being down below. Who owns this? So Pioneer Natural Resources and BlackRock. Institutional ownership makes up well over a third. And the executive suite owns a decent amount in terms of dollar amounts, not a massive amount in terms of the percentage of shares outstanding. So I think this company has started to inflect in the sense that some of these acquisitions have been value accretive, in my opinion. Their net income has gone from negative over the last quarter to positive, which is always good, without any real changes in the depreciation or amortization. That means that there's not a large amount of accounting tricks that can account for this increase in free cash flow, which you see over on the right-hand side here. So that's only one quarter. Obviously, I'd like to see that continue. Its adjusted EBITDA has made a massive jump up, and that's all looking good in terms of the M&A strategy, in terms of the businesses that they have acquired so far. But it is, of course, early days. All I really wanted to point out here is how they've been able to compound their growth over the last 5 years, both in terms of the revenue. And if you look at the revenue compared to both EBITDA and earnings, although they're not my favorite methods, just do the quick overview, it gives us an interesting take on their being able to grow the revenues and being able to grow earnings as defined by EBITDA and EPS, which might suggest some improving margins and improving operational aspects to the business model. Once again, EBITDA and earnings are very high on the income statement, so they're not the best metrics. But when I'm just taking a quick overview of a company and I say, okay, that's interesting, it's an indication that I might like to look a little deeper into what's going on. If we look into the next 12 months expected free cash flows versus the current market cap, you're looking at roughly a 12.5% free cash flow yield and very, very low numbers in terms of EV to EBITDA. They've been able to acquire businesses below this value, which is good. And boom, boom. In relation to its peers, here's where it sits. So it sits below the median EV to EBITDA multiple and, around about the free cash flow to market cap. So it's there or thereabouts in terms of the multiples. All I've done here is have a look at what I think the company can earn, take some of the analyst projections, and very simply put that into a per share number for the free cash and for the EBITDA, and then applied a comparable and a reasonable EV to EBITDA multiple. Okay. So here I've used a 4.3 for the EV to EBITDA. Here I've used an 8.3 price to free cash flow based on comparables and based on historic metrics. That suggests a weighted average price target of around 1378, which from the price of recording time at least might suggest a 44 upside over the next year that the shares could re-rate. So there is some value there, certainly in my opinion. I am not taking a position currently. That for me, I'm just waiting. I think that I have other opportunities that have multiple ways to win, and they're easier for me to see those ways to win. In addition to which, I think the prize for those companies winning is much bigger, being doubles and triples still from here, with a much clearer discount to asset value, in addition to these companies earning free cash. And so that's kind of my hurdle at the moment. A lot of the oil service companies, but the offshore guys, okay, so this is onshore with pump, the offshore guys still fit that criteria. And so I can't really justify allocating any capital towards pump right now, at least for my strategy. But it is certainly one that's taken my interest. So I've got it on the watch list. We'll keep an eye on this company. That's my thoughts for pump. I hope that you enjoyed that. My verdict today is I'm just watching it. It is a cyclical opportunistic play. It doesn't have any major debt issues. It's set to benefit from an increase in capex, I believe, and I think that in combination with their intelligent M&As will set them up for benefiting from this capital inflow that I expect to continue to compound at quite fast rates over the rest of the decade, with the world relying on more and more capex needed to get the same amount of shale to account for the oil production. Their M&A is reasonable, but their management also is not as heavily invested as I would like in terms of the amount of shares that they own. So that's my thoughts. I hope that you enjoyed that, guys. A little bit of a different take today. It's one that I'm watching. We'll see how it plays out. Maybe, who knows, in a couple of months, there'll be a sell-off and it might make more sense on a discount to book value, in which case I might take a position. But for now, we'll see. Hope that you enjoyed that, and I look forward to catching up with you in another episode shortly. Take care.